Okay, Taylor's getting married. Let's congratulate him. So now, everything that we did before was, in a way, tax planning. Is making all these recommendations, right? Put into your 401k, do the HSA. Okay. Now, a year later, a couple years later, he's been doing all that. We're good to go. Now he's getting married. So this changes the whole tax landscape for him. And a common question that clients who are going to get married is going to say, hey, how does this affect my taxes? Okay. So let's go through what happens when a client gets married and how it really does affect your taxes. So the first thing is, when you get married, you have two choices of filing statuses. There's something called married filing joint and married filing separate. Once you're legally married, you can't file single. Okay, you have to choose one of these: married filing joint or married filing separate. Now, I always tell clients that, because a common question is like, should I file separately? Because that's what they hear. And I just tell them, married filing separately is usually not the best option for most married couples. There's only, I think, 2 or 3 reasons why you should file separately, and we'll go over that a little later. But most of the time, once you're married, it's going to be married filing joint. It's going to be way better than married filing separately. Okay. Now, the way I like to see it is that what you're doing with a married filing joint return is that you're just combining 2 people's things into one now. So it's one tax return. You're just combining everyone's income together, combining all the deductions together. And then if there's a balance due or a refund on a tax return, it's just shared. We don't really know who owes what or who gets what. It's just shared. And usually it's a better tax bracket than married filing separate. And I like to see it as like, it's just having 2 puzzle pieces coming together just to see the big picture. Okay. Now, for married filing separately, that means each spouse is filing their own tax return still, just like they're filing single, but there's going to be different calculations and different limitations now. So each spouse files their own tax return. Each spouse will pay their own taxes or get their own refund. But just know that married filing separately is the worst tax bracket to be in. And there's a lot of limitations, like certain things you can't contribute into. You lose out on some certain credits when you filed separately. And it could cause higher taxes because it's a different tax bracket. And the only time, or one time, we do recommend married filing separately is for California residents, is that it actually saves them taxes once their income's over $1 million combined. Okay, so this one's a little bit more complicated. I won't go over it, but just know that this is the one instant where it is beneficial to file married filing separate if they reach that income threshold of $1 million. So any tax consultant out there that is working with tax clients and you see that they're making over $1 million combined income, this should be a red flag saying, hey, I need to ask them if they want to file married filing separate. Okay, because it could save $4,000 or $5,000 in taxes easily. Okay, and the way I like to explain married filing separately, I'm not sure if the term going Dutch is common here. It pretty much means that if you're a couple, say the boyfriend pays for his own food, the girlfriend pays for her own food. So if the boyfriend pays for the lasagna, it's however much dollars, he just pays for that. If the girlfriend buys the fish, she pays for her own fish. It's all separated, right? So that's what married filing separately is. It's pretty much just going Dutch. Okay, here are the common reasons to file separately. The first reason is if a divorce is going to happen soon. Okay, if they know they're going to get a divorce, they don't want to be tied to each other's finances, then this is probably a reason why to file married filing separately. The other one, which I don't really see too often, but if one spouse happens to have a lot of taxes or maybe even debt owed that the other spouse doesn't want to be tied to. Okay, so because if one spouse owes a lot of taxes and they file joint and they get a refund, it's just going to go to her taxes or his taxes, whoever is owes the taxes, right? So sometimes it's better to just file separately just because the other one spouse has way too much back taxes to be owed that the other spouse doesn't want to be involved with. The other one, this is going to be interesting. In the United States, if you work in a certain industry, and you have a lot of students. So student loans is very popular in the United States. Like people are in debt with student loans. But if you work in a certain industry, like if you're a nurse and you work at like a government hospital, if you work for there like 15 years or something, they will relieve the debt that you owed on student loans, right? So sometimes to do that, you have to show lower income to qualify. So let's just say it's the wife that has the student loans and the husband makes a lot of money, then they might not qualify to get that loan forgiveness because they're adding two incomes together. But if you file separately, the government only sees that one tax return from, say, the spouse. Okay, so then it would help them forgive some of the student loans. And then, like I said earlier, very high income, and this is mainly just for California residents, is that if they make over $1 million combined, then filing separate will save on state taxes. It won't save on federal taxes, so they'll owe a little bit more on federal taxes, but the savings that they get on the state side is so great that it makes up for the extra tax they pay on federal. Okay. So, but we won't go over this because it's very specific to California. Okay, so let's go through a actual scenario. This is one spouse right here, and this is another spouse. So one spouse here makes $100,000, the other spouse makes $150,000, and they're both filing single. Okay, so this is the taxes involved. So combined as two singles, they owe $38,800 in taxes. But now, let's say they got married with the same income, so their total income is $250,000. Their tax is $38,500. So no big difference, right? Like both people are working, and once you combine the income as married filing joint, there's no difference. So in this case, getting married doesn't really matter. Like whether they file single or they get married, there's really no tax benefit really in this case right here. Let's go to this other section. Let's say one spouse doesn't work at all. Let's say that spouse is a student, doesn't work at all, or they're filing single. This is a student, no income, and then the other partner is filing single, makes $250,000. Okay, so as a single, this one person is paying $25,200, but let's say they get married. Now you're combining both incomes together, right? But because the student has zero income, the total income technically is still just from that other working spouse is $250,000, but now they're married filing joint, which means that their tax is $16,200. If you can see that it's a big difference when you file joint in this situation, and it's only usually beneficial when one spouse doesn't work. That's usually the most time it's the most beneficial to married filing joint. And the reason is because when the tax code was written, long time ago, it was common for only the husband to work. And the spouse, the wife usually stayed home, take care of the kids, take care of the home. So in that case, they made a tax rule so it benefits by just filing. They wanted people to get married, so that's why it was beneficial to get married in that situation. But now it's totally different. It's very common now for both spouses to work. So let's talk about TCJA. So it's the Tax Cut and Jobs Act. I call it the Trump tax reform. This was passed in 2017, and it's going to expire after year 2025. So starting year 2026, it probably is going to expire. And the Trump tax reform actually helped make filing joint beneficial. Okay? Before that, it was actually very common that when two working spouses filed together for the first time, they got hit with what they call a marriage penalty. So they would pay more taxes by filing married. And it's usually when both spouses make around the same income. Okay? So Trump came in and fixed all that. He said, okay, that shouldn't be fair. So they fixed it. So it's a little bit more fair, but set to expire in year 2026. So keep that in mind. So now that Trump's back in office, we don't know what it's going to look like if he's going to try to extend that or not. Okay. So 2026 is going to be an interesting year to see how much that they're going to try to carry on from this tax TCJA Act. Okay. Now, the first year when clients get married, this is where they get the biggest tax surprise. Okay. And, when they're filing single, each of them, let's just say each of them gets $1,000 refund. So now they're filing joint, they're expecting a $2,000 refund combined. but the most cases it becomes a balance due of like $5,000. Okay, and the reason is, I'm gonna try to explain this so it's easy to understand, is when you're single, you make a paycheck and there's certain withholdings based off of that. And that withholding is based off filing as single, as one person making that one income. So it happens for both spouses, right? And then when you file joint, all of a sudden you're combining the income together, but the withholdings are still staying the same as single. But technically it should be higher because now you're married. So the best example I could come up, the best analogy I could come up with is that if I'm holding a cup and I have a bucket, I say I have a cup, this is my singles cup, right? The water represents my tax withholding. So every year I fill it up and then I pour it into a bucket, right? And as long as the bucket fills up, then that means I cover my taxes. Okay, and then my spouse also does it while she was single too. Now, when we're married, we both are using the same cup because we never adjusted our withholdings, but the bucket is actually one bucket that's bigger than the two buckets combined. So now I'm pouring into it, she's pouring into it, but that one big bucket never fills up. Okay, the amount that's not being filled is the balance due that you're going to owe on your taxes. So pretty much, we're both not contributing enough into taxes with our single cup that we've been holding on to. So technically, we need to get bigger cups for each person to be able to fill up that big bucket. Okay, does that make sense? Okay, perfect. Okay, so we got to make sure that the W-4, what this is a form that people will fill out to their employer to say, hey, I want to withhold higher or lower, right? So when they get married, we need to make sure that they update their W-4 right away, saying that now, because W-4 says that, are you filing as single, married, or head of household? So most people will type single, so we need them to fill in married. So making sure that the earlier the better, because if they do it in November, December, if they change this W-4 in November, December, it's too late. There's not much. There's only 2 months worth of withholdings that's going to be adjusted. It's not enough. So technically, they should be doing it even before they got married. So if they're getting married in November, they should actually probably do in like February of that year, like have the whole year. Because no matter when you get married during the year, you're considered married the whole year. So if you get married on December 31st, you're considered married for the whole year, right? So that's really important for clients to understand. Let's see, so we gotta do tax planning to ensure that the withholdings are enough, very important. Tax planning is what I always recommend to clients, is that we're doing a proactive approach on calculating your taxes to see what you might owe in the future, because by the time you file a tax return, it's kind of too late and it's gonna be a big surprise, and I don't like giving surprises to clients. Okay. The next thing, marriage changes taxes, adjust your withholdings to match, avoid big surprises. Okay, that's my whole big thing with clients, is like I want to avoid surprises, so I'm very proactive with the clients, and we'll be starting planning throughout the year. So then by the time we file a tax return, there's no surprises. I already told them what to expect throughout the year already. Okay, so knowledge check real quick. When do we normally suggest to file married filing separately? Okay. Divorce is one. I heard. What else? What is that? Okay, income above for California residents. Okay. Loan forgiveness. And one more, right? Back taxes. Perfect. When one spouse has back taxes that the other spouse doesn't want to be involved with. And that's it.